And among the Americans who will almost immediately feel the pain are farmers, because China buys a lot of their product and will slap tariffs on in response.
For years, our politicians have allowed other countries to steal our jobs, punish our workers, and target American industry and American agriculture.
The once full grain silos now sit as storage tombs, packed with crops the world no longer wants. Trump's tariffs are closing export doors, pushing U.S. farm goods off the global market. As the trade war deepens, America's agricultural engine is breaking down just as the next harvest nears. If this is just the start, what happens when soybeans, corn, and beef are next? In early 2025, U.S. sorghum exports to China, a market that once bought nearly 90% of Kansas and Texas output, plummeted from 1.4 million tons to just 78,000, a 94% collapse. Not a typo, just economic carnage. The first hit came March 4th, when China imposed a 10 to 15% tariff on $21 billion of U.S. farm goods. A month later, it raised sorghum tariffs to 34% and suspended major exporter licenses. Contracts vanished, containers were stranded, and prices sank. Sorghum stockpiles jumped 42%, pushing prices below corn for the first time. USDA cut export forecasts by 58%, hitting a 6-year low. For farmers like Dan Atkinson in Kansas, the pain is real. His last shipment hadn't even left when the new contract was canceled. Offers are so low, selling loses money and storing makes it worse. In Texas, feedlots are dumping surplus sorghum into cattle feed, but domestic use can't fill a $1.5 billion export hole. With farm loans tightening, input costs rising, and no clear relief, planting season is now a high-stakes bet. And sorghum might be the first domino. Wheat is already buckling. Between May 22nd to 25th, the USDA reported net wheat cancellations of 49,100 tons, the worst figure in over 30 years. South Korea canceled 65,000 tons. The Philippines, 12,000. Days later, Manila inked a 110,000-ton wheat deal with Australia instead. Korea followed suit, seeking more stable sources like Russia and Eastern Europe. Even with U.S. wheat priced $8.12 per ton cheaper, buyers are walking away. Why? A trust gap. After Trump reimposed steel and aluminum tariffs, China retaliated with grain tariffs. Wheat wasn't directly hit, but shipping companies added surcharges fearing future restrictions, raising costs above Black Sea competitors. Over 2.1 million tons of wheat now sit idle across the Great Lakes, up 37% from last year. Farmers in North Dakota are selling below break-even, and elevators are canceling loadouts to avoid penalties. The U.S. global wheat share has plunged from 44% in 1980 to just 11%. Meanwhile, Russia, despite sanctions, is exporting over 40 million tons, dominating key markets. Back home, the pressure is crushing. Kansas banks demand more collateral, mills are shelving upgrades, and farms are feeding wheat to livestock. Abroad, the price of staple goods like bread is rising, as consumers absorb the cost of U.S. trade instability. America's farmers now face a double blow, vanishing markets and collapsing credibility. Wheat may be next. If current trade policies hold, the U.S. could see a wheat collapse 4 times the scale of sorghum's 94% plunge. In just one reporting week, wheat exports dropped by 49,100 tons. With traditional buyers shifting to Russia, Australia, and Eastern Europe, the 2025 wheat crisis is unfolding fast. America's 11% global wheat share could shrink fast if tariffs remain DC's primary defense. The turning point came March 4th. China revoked soybean import permits from 3 major U.S. agribusinesses and hit $21 billion worth of U.S. farm goods with 10 to 15% tariffs. By April 10th, a second tariff wave hiked duties to 34%, rendering the Phase 1 trade deal obsolete. The impact was instant. U.S. soybean stocks surged to 380 million bushels, highest in 4 years. Prices dropped to $10.10 per bushel, down over 30% from $14.97 at the end of 2023. Profit margins vanished. Meanwhile, Brazil shipped 17.7 million tons of soybeans to China in Q1 alone, over 75% of all shipments. Then Argentina joined the race. On May 8, Buenos Aires signed a $900 million soybean, corn, and vegetable oil deal with Beijing. As a result, the U.S. share of China's soybean imports fell to 68% in Q1, while Brazil surged to 26% and keeps climbing. In the Midwest, silos are full and profits gone. At $10 per bushel and costs averaging $9.65, net returns are underwater. Many farmers are switching to corn or leaving land idle. USDA estimates soybean acreage could drop 4% in 2025. AgriSource warns exports could fall another 20% to 1.5 billion bushels if tariffs persist, meaning no recovery in sight. Markets see the writing. By May, CBOT November futures hovered at $10.20, near the 2020 low. StoneX dubs $10 the death line. Below it, most farms lose money. Meanwhile, Brazilian prices climbed 7% on soaring Chinese demand. U.S. beans are stuck, cheap, unsold, and outcompete. Sorghum is already gone, down 94%. Now soybeans, the top U.S. crop, are teetering. Without a tariff reset, mass bankruptcies loom next fiscal year. Meat exports are next in line. Nearly 1,000 U.S. meat plants lost valid licenses to export to China, putting $5 billion in trade at risk. Since mid-March, Chinese customs have enforced full inspections, unsealing, unloading, X-raying every shipment. Many spoiled on the dock, racking up $800 to $1,200 per container in extra costs. Some ships diverted to South America. Markets responded fast. On April 9th, lean hog futures dropped to 89.78 cents per pound, an 8-month low. Live cattle followed. That same week, China canceled 12,000 tons of U.S. pork. Prices plunged further. Every 1-cent dip in hog prices cuts $15 million per month from Midwest incomes, matching the sorghum crash in economic damage. U.S. farm exports jammed as tariff war deepens. While a backlog of U.S. exports sits frozen in Shanghai, reports say some meat shipments had to be retempered 3 times, risking spoilage and bacterial contamination. Over $10 billion worth of American goods, from frozen meat to wood chips, are stranded, with no time left to beat China's looming 125% tariff hike. As cold storage fills up, companies face 2 choices: dump products at fire sale prices or discard them. Domestic meat prices dropped fast. USDA now projects 2026 hog prices to fall 3% below this year, marking the first multi-year drop since COVID. Southeast broiler prices slid 7% in April, and premium beef lost $2 per CWT on the same day the White House raised tariffs by 50%. Plants preparing for summer demand instead cut shifts or went idle. With China, the third largest buyer, shutting its doors, U.S. livestock markets are crumbling, prices falling below feed and storage costs. If tensions persist, USMEF warns up to 1 million tons of U.S. meat could vanish from export pipelines within a year, slashing producer margins up to 15%. After sorghum and soy, livestock is the next casualty of America First. Farm bankruptcies are climbing fast, yet there's still no sign of revival. Ports backed up, supply chain cracks. U.S. AG exports are gridlocked. Portland lost 51% of outbound volume in just 10 weeks. Tacoma dropped 28%. Even L.A., the West Coast's largest port, is down 17%. Savannah and Norfolk are seeing double-digit drops too. Each point lost means tens of thousands of tons of grain stuck in silos. LA's vessel calls fell from 12 a day to 5. Stevedore crews were slashed. Empty ships mean no containers for future shipments. Midwest farmers can't even rent boxes for sorghum or soy. Making it worse, Washington floated a $3 million tariff per China-built vessel. Carriers like MSC threatened to cut service. United Grain estimates this would hike freight 40%. Traders are already shifting to Australian barley. Its sorghum's 94% export collapse all over again. Input costs surge, credit tightens. Canada retaliated with a 25% tariff on $30 billion in U.S. farm goods, hitting combines, pesticides, and most critically, potash. Since 80% of U.S. potash comes from Canada, fertilizer costs are spiking. A 2,000-acre Nebraska corn farm now needs $60,000 more just to fertilize. Costs are rising while cash flow vanishes. Margins collapse, prices sink. Farm profits are vanishing. A bushel of corn now nets under 8 cents, down from 40 pre-tariff. Freight and fertilizer eat 12 cents per bushel alone. Fewer sailings mean fewer containers, which means more canceled contracts and lower spot prices. Banks tighten credit, creating a downward spiral. Credit, the lifeline of U.S. farming, is choking. Q1 data shows AG loan delinquencies up sharply. Chapter 12 bankruptcies rose 55% in 2024 and are still climbing in 2025. It's starting to resemble the 1980s farm collapse, only this time it's tariff-driven, not rate-driven. And the pain won't stay on the farm. When credit fails and jobs vanish, diners, gas stations, and schools go down too. Without action, this isn't a warning, it's already happening.